Good morning, everyone. We'll start in a minute or so, just wait for more people to join. And just a quick sound check, if you can please type a 1 into the chat window if you can hear me okay. Thank you. Plenty of ones. Perfect. So we'll start in a minute. All right, let's get started. Good morning, everyone, and welcome to today's Tuesday Market Outlook session. My name is Prakash Vijayanath. I'm a senior analyst here at OptionsPlay, and today I am going to be walking you through how I am viewing the current markets. So before we get started, just the usual disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by OptionsPlay or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So our agenda for today, we will be kicking off with the major indices as usual, highlighting those key levels to be made aware of, especially this week where we have seen multiple hits of those key levels for the S&P. From there, we'll be moving on to fixed income and commodities. We'll take a look at the sector rotational model, highlighting which sectors are outperforming and underperforming the overall market. We'll have a look at some subsectors of interest that I have for you today, and we'll end today's session with some bullish and bearish market observations. And before we move on to the major indices, just to quickly recap the Fed rate hike probabilities for the next Fed meeting, which is on the 14th of December. So currently the target rate is at 375 to 400. And right now markets, or Fed futures, I should say, are pricing in a 50-point hike with a 70% probability of that happening and a 30% probability of a 75-point hike. And I think that makes sense. I mean, if you consider the fact that the last inflation report came out better than expected, indicating that we may have already surpassed peak inflation, it's only natural to expect the Fed to not be as aggressive with their rate, with their trajectory of their rate hikes. However, the one thing I do want to point out is the fact that the last time we spoke, there was an 80% probability of a 50% hike, and that has now dropped to 70%. So I think investors are now starting to see that maybe there was a overreaction to that one inflation announcement, which makes sense. I mean, it was only one data metric, and I think we need more than one piece of data to really establish a trend. This week we do have jobs numbers coming out and unemployment data coming out, so that will definitely be closely watched by the Fed and by investors. So these probabilities may change quite drastically this week. And we also have another inflation announcement coming up before the 14th of December. So those are going to be the two key economic events over the next couple of weeks that you'd want to keep a look at. So taking a look here at the S&P 500. So we didn't do a market outlook last week. But the last time we spoke 2 weeks ago, we saw that price was starting to edge towards the 404 area. And recently we are seeing that area is holding as resistance. We've had 2 rejections of that area already in the last 2 weeks. Price action is quite bearish at that area. However, in my opinion, this doesn't necessarily mean it's a reversal. Because if you do look at the price action, yes, it's rejecting 404. However, it's not really showing a lot of bearish momentum. even today, futures are set to open, or futures are indicating the S&P is set to open a little bit higher. I think markets are going to be waiting until we get that jobs and unemployment data come out, so we have a better idea of where to head next. But in terms of trading strategy and how tactical you want to be for this week, I think this week it makes sense to probably minimalize trades and trading volume, simply due to the fact that markets are not consolidating. There's still some ambiguity, not the same ambiguity that we saw around a month and a half ago between the technicals and the fundamentals, but this is more short-term ambiguity where we've priced in a 50-point hike, we've priced in a more dovish Fed. That's already been done. However, we don't know if that will be the case, especially when we have two key economic data points coming out over the next 2 weeks. So until we really get a better picture, I'm not going to really take a huge guess as to where the S&P is going to go. That being said, 404 still holding as a resistance level, and the next key area of support still sits at 380. On the weekly time frame, however, price is in the middle of no man's land, and I think this also provides a good idea of the potential upside here for the S&P, with the 23.6 fib level at around that 418 area. So if we do get good news when it comes to inflation and jobs, what we could see is a move higher here to the 418, 420 level over the next few weeks, heading towards 2023. Taking a look here at the NASDAQ 100. NASDAQ 100, not moving, somewhat underperforming the S&P 500. Price is at its 55 and 21-day exponential moving averages, managing to stay above it and managing to stay above this previous minor resistance, which is looking like it is turning out to be a short-term or a minor support level. But again, fundamental catalysts could easily break down this level, and we could see a move lower if we see a negative jobs announcement here with regards to inflation. And also, if we do see a positive figure, or if investors interpret it positively, we may see that price action continue to grind higher, head towards that 300 key area. So not only is it a strong area of support slash resistance, as we can see on the weekly time frame, but it's also a strong psychological level. So you want to keep a note of that. Moving on to small caps. So small caps, last we spoke, price was at around the 188 area. That was the 38.2 fib level, and price is respecting it. We saw a strong rejection a few days ago, followed by a move back down to revisit its 21 and 55-day exponential moving averages, or more its 21 exponential moving average, really. And we can see here that price was trying to revisit there, but no real volume last week, and a big bearish day yesterday. So again, a bit of a consolidation pattern forming here for small caps and equities as a whole. But small caps definitely respecting the fib levels. Next key area to break above would be 188, followed by, revisit back to potentially the 200 previous swing level, or even 210, which is a 23.6 fib level. In terms of areas of support, 170 would be the key area to be looking at, which is a 50% fib level, and also 163, where price on the weekly time frame did form this double bottom here. But you can even see on the weekly chart over the last few weeks, the small caps, we have seen a lack of momentum relative to large cap names. And a few weeks ago, I pointed out the fact that small caps were outperforming large caps and they were starting to break out, which is a very bullish sign, or traditionally it's used as the early signs of a bull market, which we knew isn't necessarily the case, but it's still a bullish sign. Whereas we tend to see that trend reverse, and we are seeing large caps now and outperforming small caps. And obviously that comes down to the fundamentals in play. But it is interesting to see that trend has reversed, and maybe we shouldn't be as bullish as we were a month ago. Okay, taking a look here at the VIX. To be honest, not really much to say on this chart, but just want to touch base on it. VIX has continued to move lower quite aggressively, back down to almost a 20 area, moving a little bit higher this morning to 22. I find this quite surprising, and honestly, I'm not sure why, but considering the fact that the VIX is moving higher and Fed futures were actually higher at the time of the screenshot, normally you'd expect, not Fed futures, sorry, equity futures. You'd expect equity futures to be lower when the VIX moves higher. But again, we are seeing this continuation of this trend that we've noticed for the last almost 2 months, where the VIX and equities aren't as inversely correlated as before. Before, say a few months ago, during normal conditions, we tend to see the VIX and equities have a almost perfect inverse correlation, where if equities move lower, the VIX moves higher, and vice versa. However, in the bear market, especially when you're approaching the bottom, that inverse correlation tends to disappear, and we actually tend to have a bit more positive correlation, where even if the major indices move lower, the VIX still tends to move lower, and that is what we are seeing. So still a positive sign from the VIX, the fact that it is quite low. And of course, that aids to the fact that we now have better trading conditions. We can diversify our trades a lot easier. There isn't as much systemic risk, and there isn't as much correlation across the board with equities that we have seen when the VIX was above 30, making it very difficult to actually diversify your risk. Okay, taking a look here at TLT, which is a bond ETF. And TLT has now approached the key level at around that 104 area. This was a previous support and resistance level. And now price is back to revisiting that. I wouldn't necessarily say there's a lot of bearish price action. And we did see an intraday move lower, followed by, so far this morning, it's set to open a little bit lower. Now, when it comes to bonds are naturally still going to be under a little bit of pressure. But of course, with the fact that the Fed aren't, most likely not going to be raising rates by 75 points and only raising it by 50 points, there is a short-term reprieve here for TLT, which is why we have seen price actually breaking above its 21 and 55-day exponential moving averages. Do I think this is a full-on reversal of trend? Definitely not, but I do think there's still potential for additional upside, even towards that 110 area here for TLT, especially when you consider how heavily oversold bonds are at the moment. And taking a look at the US dollar, and very interesting price action that we've seen here. So it looked like, a few weeks ago, nothing was stopping the US dollar. It was continuing to move higher, and then it fell into a period of consolidation, which by no means indicated a reversal. So we saw prices finding support at around 110 with resistance at 114. And then the most recent inflation data came out, indicating, of course, the potential for a more dovish Fed. Price then broke below 2 areas of support in a matter of 2 days, the 110 area and the 107.50 area. And it did hit our downside target of 105.50. And it's actually forming a small double bottom so far, as you can see. That being said, it doesn't necessarily look like there's a lot of momentum for potential upside. And it does tell me that I think the US dollar, like the major indices, are waiting on more data to know where to go next. I mean, we have resistance obviously at that 107.50 level, and of course back at 110. In terms of the longer term outlook, we have to remember that the US dollar is compared to different currencies to essentially derive its value and derive its day-to-day performance. And the biggest weighting the biggest weightings are, the euro, pound, yen. These are the currencies that you really want to be looking at. And when you look at the euro and the eurozone, there is now this week some evidence of inflation may have reached a peak already. We are seeing inflation data come out for Spain and I believe Germany a little bit lower than expected. So that is positive news. for dollar bulls, because what that means is the European Central Bank doesn't have to increase rates with the same aggression that they have been over the last few months. And what that would mean is, from a relative perspective, the dollar will gain some momentum relative to the euro. So I don't believe we'll see a very weak US dollar just yet. Definitely need more evidence from the Eurozone and, from Japanese economy as well. But for now, price is holding that 105.50 level. And taking a look here at gold, which does generally move inversely with the US dollar. Not so much in the last few days, but we have seen price, kind of spike up to that 165 level. It was quite overbought and naturally saw a bit of a pullback, a bit of a fade. And, we actually are seeing some bearish price action. Look, we saw price decline now down to 161. Tried to move higher, failed yesterday, actually had quite a bearish day, but set to open a little bit higher this morning. If the US dollar does run into further weakness and breaks below that key area, I wouldn't be surprised to see gold actually reach that 167 level. But I do think that needs to be the catalyst here for gold for it to continue to the upside, because it has risen quite drastically, quite quickly. And let's say the US dollar does find support and actually moves higher. Wouldn't be surprised now to see gold continue lower and back down to that area of support at around that 157.80. In terms of further support at 150, 152, I have my doubts as to if gold would reach there anytime soon in the next few weeks. I don't believe it will. That would require a drastic rally here in the US dollar, which I still don't see happening. And moving on to oil using the USO ETF. So oil was a very difficult chart to read for quite a while. So even though we established this topping formation with a neckline at 71, we saw price break up and break below that neckline and had very, very choppy price action for almost a month, a bit more than a month. But more recently, we did see price break below the 71 level, looking like it was heading towards 63. However, we are seeing a recovery here in the last couple of days. So a lot of this price action has to do with what's happening in China. Now, we are seeing a lot of riots and protests about China's zero COVID policy and how harsh it can be with regards to the lockdowns. And we have to remember that with China being such a huge consumer of oil, when you have a lockdown and that demand decreases, naturally oil prices do decrease as well. So the fact that we are seeing this protest, and then the fact that we are seeing maybe a shift in policy from the healthcare commission in China, we are seeing oil starting to find some support and potentially head back to that 71 level. But right now, it's really China that's almost dictating the short-term price action here for a year or so, believe it or not. All right, so taking a look at the sector rotational chart, we have 6 sectors in the improving and leading category and 5 in the lagging and weakening. And ultimately, there hasn't been that much of a change in the last 2 weeks. I think, or let's say there hasn't been too much of reversals when it comes to sector rotation. We've really only seen the trends that we've already established 2 weeks ago pretty much just continue over the last couple of weeks. We still have energy in the leading category, providing that leadership. But we have materials, financials, healthcare, staples, and industrials as well. So you can't really see that. But we have all these sectors in the leading category, and we have the rest in the lagging category. So nothing really in the improving and weakening category. So it's almost like this very clear view of what sectors are outperforming and what sectors are underperforming the overall markets. With that being said, we have technology over here that has been really the one sector to have seen a bit more of a sharper reversal in terms of relative performance in the last few weeks. You can see technology is moving higher, heading towards that improving category. and naturally it is dragging the major indices along with it. So let's see if that momentum can remain, because that will naturally be a nice tailwind for the major indices as well. We still have our defensive sectors within healthcare and staples providing some leadership, and that makes sense considering we're still in a fairly ambiguous environment until the next Fed meeting. But we have utilities underperforming. We also have discretionary moving lower quite drastically, and communications. So a lot of weakness there in communications for pretty much the entire year. So moving on to some subsectors of interest that I have for you today. And I want to take a look at KWEB, which is the Chinese Internet ETF. And we are seeing, again, some evidence of government officials in China not really reversing their stance on internet companies, but maybe being less draconian about it. And that is also having a very positive impact here for internet stocks, not only in the last couple of weeks, but even this morning, with this ETF set to open a little bit higher here at around that 26 area. If we take a look at the weekly time frame, though, we saw this huge decline, and price was finding some support at around that 21 area. It initially looked like there was going to be a breakdown, but price managed to break back above it, and now breaking above its 21 and 55-day exponential moving averages, coming down to retest that and moving higher. So this would indicate a potential second leg here on the cards. And I'd be looking at 32. I know there's the next key area on the weekly time frame was a 40 area, but 32 as well on the daily did provide some resistance in the past. So that will be my shorter term price targets here for KWEB. Okay, taking a look at SMH, which is the semiconductor ETF. And again, this was a name that we did look at a few weeks ago, and we have kind of looked at almost for the last month. And price, after finding a lot of momentum, which was quite surprising considering the fundamentals for the subsector as a whole, isn't great, still maybe in the gray area. But we have seen pricing break above the 200 key area, move higher thanks to the inflation numbers, and it is now at that area, which was a previous area of support at around the 216 to 225 level. And price is struggling to break above it. It hasn't really found that momentum to break above it, kind of consolidating over the last couple of weeks. So from a risk to reward perspective, obviously I would be looking at some downside potential. And also because I'm still not too convinced about the fundamentals here in play for semiconductors. I think as a whole, I'm not saying semiconductors are in any way a bad investment. I definitely think there's some very good picks within the semiconductor industry for a longer term holding, but from a pure tactical and timing approach for the short term, I would say I have my doubts here for semiconductors, and my bias would probably be leaning more towards the short side with 200 as a potential target price. So moving back onto some Chinese internet companies, we have Alibaba. And Alibaba, this is more of a bullish idea that I have. So we have overall a long-term decline, no doubt about that. And more recently, though, price did manage to break above that 75 level, set to open a little bit higher this morning. And what I see here is the potential for a short-term bullish setup. We had an upside earnings beat that saw price that provided the catalyst for price to break above its EMAs, and we have now seen that pull back, retest, and bounce higher. So that would give a very, very good risk to reward bullish entry point for the next key area, which is clearly that 88, 89 level, which did provide support in the past. Okay, taking a look here at General Motors, so another name that we looked at a couple of weeks ago, potentially for a bearish trade. And I would say our thesis for this has been somewhat correct. the original thesis for this was that price doesn't break above that 40-41 area of resistance. So far, that level has held as resistance. However, if we look at the daily charts, we can see that it hasn't exactly reversed lower with a lot of momentum. So it depends on the strategy that you use. The credit spread would have worked really well with this trade, even though price hasn't moved that much lower. You're benefiting from theta decay. However, debit spread, like a put debit spread, less so. I mean, there hasn't been a move of big enough magnitude to see price moving below that break-even point. So this thesis is still valid, but I would be looking at it over the next few days quite closely to see if that level can still hold as resistance. Taking a look at Cleveland Cliffs, which is another new idea, and it is a bearish trade idea here. So we have minor resistance at 16, long-term downtrend on the daily and even on the weekly. And price once again retesting that $16 level and again rejecting it, especially yesterday with that nice intraday rejection. So risk to reward easily does favor the downside here for Cleveland Cliffs. And I'd be looking for a revisit back to this somewhat of a base formation at around that between 12 and 13. And finally, taking a look at another name that we looked at a couple of weeks ago, which was Lowe's. So Lowe's, part of the home builders subsector, and even though it has experienced maybe a bit of some short-term momentum, we saw how very quickly price from 185, 180 managed to rally to 210 in a matter of a couple of days. That is still a resistance area. We've seen it act as resistance on multiple occasions. And if we look at the weekly time frame, we can see price is struggling to actually break above and close above that 210 to 11 area. And we are seeing a loss of momentum in the last few days. So again, risk to reward does favor the downside for this trade, but you'd probably want to keep the stop loss quite tight. And if there is a close above that 210 on a weekly time frame, I'd probably look to close that trade and limit some losses. Next key area of support here would be at around that 190 level. But overall, when it comes to picking trades in this current environment, I don't recommend trading too much, and given the fact that there is still some ambiguity, but there are still some opportunities. It's just that a lot of these opportunities, with the risk to reward based on the price action, they do favor the downside because of the recent rally in stocks across the board. So that is important to remember. I do think, it makes more sense from a tactical perspective in the short term is to be shorter term, somewhat neutral to bearish, but longer term bullish, because what this bear market has given us is a great opportunity to buy longer term holdings. We've seen a lot of these tech companies with crazy valuations come down, but are still very good longer term picks. I know we've discussed them in the last few weeks. CrowdStrike is the first name that comes into mind, a name that we've discussed quite often. But then that's just one example. But when it comes to shorter term setups, it does look like you'd want to favor the downside just because of the fact that we've seen a systemic rise in equities across the board, and a very quick rise across the board. So you don't necessarily want to hop on a long trade when you know there's more potential for a bearish trade at that stage. And with that, that is all I have for you today. Thank you so much for joining me, and I hope you all have a great trading week. I will see you next week. Bye.